All right. Hi, this is Jeng, and today we're going to be talking about multifamily financing. And right now there's a lot of economic news coming out. So I wanted to provide sort of where multifamily financing is today, and then a little bit about collections and sort of financing and next steps, sort of how you're going to finance a deal in this market. So let's jump into the next slide here. So this is really the basics. So for a multifamily investor, there's really four types of loans, right? So you have a bank loan, you have a Freddie Mac SBL, you have a Fannie Mae loan, and a non-recourse bridge. So most people start on the left-hand side, right? So most people do a bank loan. It's 3 to 5 years. It's 20 to 25 year AM, 75% max leverage. That's where most people start, and it is recourse, right? So if you ever get foreclosed upon and there's a deficit, when the lender goes out and takes that property back, then you're responsible. They can come after your personal balance sheet. And then as you get into larger and larger properties, you move into Freddie Mac SBL, and then Fannie Mae, and then potentially non-recourse bridge. And so on the Freddie Mac and Fannie Mae, you're really looking at longer term loans. So you're looking at 5, 7, 10-year loans. They want the occupancy to be 95% or 90% at a minimum. And then, they will do anywhere from 1 to 3 years interest only. And so the Freddie Mac SBL program goes from essentially 1 million to about 7.5. And then Fannie Mae starts at about 750 and goes, 100 million. You can do very large Fannie Mae loans. And then, so once those are stabilized products on the multifamily side, but then once you get into non-recourse bridge, this is going to be items that you might need more flexibility on the occupancy. You might want a shorter term, 3 to 5 years, to really add value and then sell or refi that property. And so your prepayment is a lot lower. So it's a 1% prepay. And so, what we're going to be talking about today is mostly from the general partner and limited partner standpoint. But, whether you're an individual who's sort of looking for their own deal, essentially you do everything as an individual, right? You sign on the loan, you negotiate the transaction, you manage it, you put in all your equity, right? So your focus really is on finding new deals. But as you move over to, let's say, the general partner and limited partner side, the limited partner's job is almost the exact opposite. Like, you don't sign on the loan, you don't do the asset management, you don't, find the deals at all, really. Your job is essentially just to find general partners to invest with. And then sort of right in that middle column, the general partner, they do everything, right? They're signing on the loan, they're finding the deal, and then they're raising equity from limited partners. And so the only thing difference between a general partner and individual is you're not putting in all the equity, right? But your job is now to find new deals and limited partners. So I'm going to go through some examples. A lot of people on this call are probably in that general partner, limited partner framework. So let's talk about that. So if, let's say, I handed you a $5 million deal and said, hey, I need you to close this in 60 days as a general partner, could you do it? Right. And so that consists of two things, right? So you have, let's say, equity of $1 million and $4 million in debt. And in order to qualify for that $4 million in debt, they're going to want your net worth to be greater than the loan amount. So your sponsorship group's net worth to be greater than $4 million, right? And in post-close liquidity, they want 10% of the loan amount. So 400,000 in post-close liquidity. So post-close liquidity is cash or marketable securities on bank statements in the bank already, non-retirement. And third, they want prior multifamily experience. And so the way I like to think about it is, when you're putting together your sponsorship group, there's really four things here in the bottom left around finding the property, the ownership, multifamily ownership experience, raising the equity, and then net worth and liquidity. And so it can range. So let's say you're getting 20% compensation for putting the deal together. It can range from, 19% to 1% on how much each person is going to get. And that's going to depend on what they're bringing to the table, right? So let's say the investor found the deal, they're raising equity, they might get 9%. Investor two might get 8% because they're have the experience and they're raising equity. And then the people with net worth and liquidity, they're not going to get as much, right? Because it's more common, like if you're walking down the street, it's more common to find somebody with net worth and liquidity than it is multifamily experience or even finding a deal. And so I wanted to bring this deal up. So this is a deal that's currently on the market here in Dallas. Smaller deal, 52 units, $4.4 million purchase, $3.5 million loan. So very similar to what I talked about. And so I want to throw this example up there. So I used my 3 kids' names. So Joshua, Caleb, and Ryan. Pretend there's 3 investors, right? So Joshua, he lives up in New York, doesn't really have any experience, can raise equity, and then he has total net worth of 1.5 million. And then investor 2 is Caleb. He lives in California, no multifamily experience, but he's got $3 million net worth, which is great, and then 500,000 in cash. And then Ryan, he lives in DFW. He finds the deal, right, because it's in his backyard, and he has multifamily experience. So who do you think should get the most equity in this deal? So maybe put it in the chat. I'll try to make this a little bit more interactive. Put in the chat, who do you think should get the most equity? Like if they're splitting up 20%, who should get the most equity, and how much equity should they get of the 20%? Should they get 10%, 20%? How much of the equity should they get? And so I see a lot of people are leaning towards Ryan, my youngest, and how much they're getting. All right. And then, all right, so Ryan's the clear winner. He's getting a lot of the equity. Between Caleb and Joshua, who should get more equity, do you think? So Joshua has 1.5 million in total net worth, and he's going to raise equity. But then Caleb, he has $3 million total net worth, but he's not going to raise any equity. So that's a little bit harder question around how much equity you should give to that person. And so a lot of people are leaning a little bit more towards Joshua just because of that ability to raise equity, especially in this market. So let's throw up. I think I had it here. All right, yeah. So I assigned 13% to Ryan, 5% to Joshua, and then 2% to Caleb. So that was just a little case study. Thanks for participating in that. And then let's just keep going. So that's how you think about forming your sponsorship group. So here is May collection number. This was as of sort of last Thursday, Friday. So about halfway through the month. And these are all deals that I'm invested in. So you can see on the Class A side, we're essentially seeing close to probably about 95% of the rent in May that we're going to collect already. And so April's collections, so if you look at, let me break this down. So the May collection, so this second to the right column is May collections versus March, right? So most of the A deals here are about 95%. So this one deal, this Class A deal, essentially had 3 or 4 retail tenants. And, ground floor retail on a multifamily, unless it's in sort of a high density area where there's a lot of walk-by traffic, is difficult, especially right now. So they had to essentially close. And so we had to give them essentially their rent for free for the next 3 or 4 months. So that, if you exclude them, that's probably closer to 94%. If you look at the B stuff, most of it is 90%, 92%, 93% in that range. The C stuff is closer to that 85 to 90% so far. And they have trailed. And so I think it's gonna improve. And then National Multifamily Housing Council, they came out and they said they're about 87, 88% right now on the rent collection. So I think everybody's in pretty good shape so far in May, and pleasantly surprised with May so far. So I want to show some slides. So Ken McElroy talked about sort of the ripple in the pond when you drop the pebble is sort of the COVID-19. That's going to lead to unemployment, stimulus, defaults, bank REO, time to buy, and inflation. So I wanted to sort of go through that and sort of updated charts that I've seen recently. So on the COVID-19 side, this was a chart that stood out to me. It was just, we're in the bubble of the US and maybe Canada, and, GDP is going to be negative, definitely second quarter, but we haven't really seen anything where it's negative across the world. And so, Robert Kiyosaki explained it as essentially like a 9/11 in every city. And so you just can't, we don't really know how much that's going to impact. Here in Texas, pretty much everything's opening up to 25, 50% by the end of this month in May. So I think it's going to slowly start opening up. But then, even when you go out, it's a little bit longer. People are a little bit afraid and, staying away from each other. So this came out last week, just sort of the April unemployment rate going all the way to 15%. So that's definitely the high. This chart didn't show the Great Recession, or Great Depression back in the 30s, but that's where it was. And then in terms of the stimulus, really, I think, they're working on this HEROES Act that they're trying to put through right now. It's not approved yet. There is a little bit in there for homeowners, potentially renters. So we'll have to see what gets approved. But really, the chart on the left is the thing that is, giving people a little bit more hope, and maybe the stock market a lot of hope in terms of the amount of stimulus that the Fed is pushing in. And so I wanted to show. So this was I pulled some of these charts from Moody's, and it was around, like, I don't think people realized how tight the financial conditions got in March. So if you look at the chart on the left, essentially, February started, they looked at all these different premiums to really drive, the financial conditions of the market. And you can tell in February is essentially, everything was definitely on the looser side. And then right when you entered March, I mean, I would say this is probably that March 15th toward that bottom, March 15th to March like 23rd. And that's where essentially like everybody pulled back. And so the market got very tight, and that is where a lot of the Fed stimulus is coming in to essentially be lender of last resort is the Fed right now. And so so from March to today, it's significantly better. But then, compare today's versus February, it's very different. And so on the right-hand chart, you can show the amount of money that was coming out of money markets at that time. And so, that just shows you an idea of how many people were pulling down their credit lines, how many people were, just going to cash at that point. We have the COVID-19, the unemployment, the stimulus, and then eventually that's going to lead to default. So that's what I want to talk about here in the next section is, on the left-hand side is the CMBS side, and, hotels, this is probably a couple weeks old, but, lodging's already 20%. Going into workouts, retail's there, multifamily, there's a little bit of spike up, office and industrial have been pretty flat as well. But I wanted to show you the spreads. So on CMBS, what you do is you basically take a bunch of loans and then you cut it up into pieces. And so people can buy based on the rating, the AAA all the way to the BBB. And the BBB is the highest risk position. That is the position that if there is a loss on the CMBS securitization, those people get hit first, and then it sort of reverts back to the AAA over time. And those spreads blew out significantly, where basically people could not do securitizations. And you can see that at least from a week ago to last week, it was slowly coming down, the BBB spreads. And so I think as more and more people take securitizations out, then that will become easier to do. In terms of bank REO, this is, I guess we're still in defaults here, but this is Fannie Mae. So Fannie Mae every week puts out a list of loans that have requested or gotten approved for forbearance. And so it started about 3 weeks ago. In April, there was about 29 loans. And then in May 7th, it went to 58. And then this last release, it had 115 loans. So I see this, I hope it doesn't keep doubling, but I think it's going to grow at an exponential pace here as more and more people request forbearances. I couldn't fit the whole thing on the slide here, but you can see that the list is growing. On the Freddie Mac side, it was, they put this out sort of mid-April, so I think it's going to increase as well. But the interesting thing was that they showed the conventional business. So the conventional business is like A and B properties, and only about 0.5% of those had requested forbearance. But on the small business side, like we talked about the Freddie SBL, that was anywhere from 1 million to 7.5 million. That's showing about 3% in forbearance. And so that one is going to be a little bit trickier. I think that one, whether it's just because it's smaller properties, smaller owners, not as much capital, and they're requesting forbearance. So there's going to be a little bit more of a shakeout, I think, on the small balance side compared to the conventional side. And so I want to drill down a little bit. And so, Freddie Mac Freddie SBL puts out, why do loans, number one, go on the watch list? And then once they are on the watch list, why do they go to special servicing? And so the watch list is, there was all these examples from delinquent on obviously your principal and interest, right? If you're not making the payments for a month or 2 months, you're going on the watch list. If you miss your tax and insurance payments, if your debt service coverage falls below that 1.1, if they go out to the property and it's just in poor condition, you're going on the watch list. Less than 80% occupancy, because most of the deals that they did were 90% and higher. If you had a major casualty, failure to submit your financials, code violations, or if you have a maturity that's coming up. And so, some people, I think lenders notify the borrower if they are on the watch list, but definitely if your property is on the watch list, you're not going to be able to get a new loan from Fannie or Freddie. So definitely track the condition of your property and all these things to make sure that you do not go on the watch list. Once you're on the watch list, your goal is to get off. But if you do not get off, the next worst bucket is special servicing. And special servicing on a lot of these, essentially the borrower really isn't working with the lender at this point. And so we saw examples of borrowers filing for bankruptcy. They didn't have insurance on the property, code violations, unpaid taxes, properties got flooded, and just not being responsive. And one property actually who's in special servicing had lost their Section 8 status, and so their condition was so poor that they couldn't even rent to Section 8 people anymore. And this was one example. Was this deal was so bad that the property management company left. They had left the property. They the owner wasn't paying them, and the property management couldn't pay vendors. So that I think is the deals that are essentially going to be hitting REO. So when you see defaults, it's going to go to watch list, then it's going to go to special servicing, then it's going to go to REO. So essentially in all of these special servicing comments, they said, look, we're just trying to sell the property for whatever we can get out of it and, move on. So those are the deals that you're going to see coming to market. So, when you're thinking about timing of when you're going to go buy your next deal, I would think we're sort of right in this spot right here, sort of late 08, 09 timeframe, where we're seeing a lot of this new distress. So like this blue line of the new distress, that to me is the increase in forbearances, the increase in delinquencies. That is just starting to ramp up, right? But then, the workouts and resolutions of these deals, it's going to be 6 to 9 months longer, right? So you might have 6 to 9 months of this new distress, and then you have the price discovery. So that might take you 12 to 18 months out. Here's a chart of GDP versus the chart from Real Capital Analytics. And you can see that it was negative for 2 or 3 quarters here, GDP, and it popped up back in 2010, positive GDP. So that's one of the signs that I'm looking for to see sort of some of the bottoming there. In terms of GDP forecast, though, the Atlanta Fed came out and they were essentially negative 30 to 40% in Q2, which is the worst of all time. And then Moody's came out and they said, Q3, Q4 is going to go positive again. So I would love to see a rebound that fast. We'll just have to wait and see if it happens. But, at some point it's going to be time to buy, right? And so what are people looking at in terms of time to buy? And this was an interesting chart that compared the cap rates versus 10-year treasury. And right. And so if you look in 2007, 2008, there was 100, maybe 200 basis point spread between your cap rate and 10-year treasury. So that would be like buying deals at a 2% cap right now or 3% cap. And in comparison, where we are now in March, 10-year treasury, let's say your cap rate's 5, 10-year treasury is 0.6, 0.7, right? So you're getting a 450 basis point spread to the 10-year treasury. And, treasuries right now, nobody really sees treasuries just riding up hugely or increasing significantly. And I mean, even, I think it was the 3-month treasury or 30-day treasury went negative, right? And so negative interest rates might be in our future. So that gap between Like if people are sitting on savings and they're having to pay for those savings to be in there to the bank and not earning interest, I think people are going to start pushing out and start buying these deals even at lower cap rates. We had David Moore on at Nightvest, and he thinks negative interest rates are coming, and he actually thought cap rates are going to go down from where they are today because of this. So it's interesting to think about, and that spread that you're giving the people, I mean, it's a huge spread in things that timing to buy. This was from the Fed, and essentially showed where lending standards were, and zero is sort of like your baseline. And you can see in the sort of last recessions, it sort of tightened up. 2001, it tightened up to maybe about 60 on this scale. In 2008, it went all the way up to 80, 90 on a scale of 100. And then Q1, similar to what we saw, was closer to 80. So I think it's going to be up there for a while on that side of it. And then, a lot of people are thinking, inflation is going to run away on this. And, here's the average inflation by decade. And I think it's a little bit misleading. But, I think that 1% to 2% is on certain basket of goods. Whereas if you look at maybe healthcare, you look at rents or any of those things, it's a very different story. So I think there definitely will be inflation. It just might take a little time. Here's some updates on the financing side, from Fannie Freddie. So Freddie Mac conventional, they're seeing on their book, right? So we talked about their book is typically 10 million, maybe 15 million and up, class A, class B. And so those guys really haven't been hurt, right? So the collections were, 85, 90%. So their model is doing fine. Nobody's requesting forbearance. And so they are releasing a couple things. They're, opening up a little bit here. So they're allowing you to, lock a little bit earlier in terms of your index and your spread. And then they're also, in terms of the reserves, if a deal is full term IO, so that's probably 65 and under, then you're just going to do IO on the reserve. And then even if it's below 60%, they're going to waive the debt service reserve. So they're opening up slowly. Freddie Mac small balance, they haven't really introduced anything on their reserves that's different. But this past week, they eventually said, every borrower is going to have to disclose if they are taking forbearance or currently in it. And then student concentration, I mean, this is something that nobody really predicted, but around, student deals, they're becoming very tight on student deals. And because nobody really knows what the market's going to be in the fall. And so if you don't lease them up in the fall, they're not going to come back. And so there could be, 18 months of, downturn for student housing. And on the Fannie side, what we've been seeing is, at above 75%, you're pretty much going to have to keep it delegated. And what that means is essentially there's, let's say 15 Fannie Mae underwriters. If you want more than 75%, you're going to have to keep it delegated to them, and you're going to get 1 year IO. And so just keep that in mind. And then on 10-year loans, they use a 5% underwriting floor. So if you do not, your rate might be 3 to 3.25, but if they have to underwrite to that 5% floor. So keep that in mind when you're looking at deals. So we've been through this slide before. I just want to touch on a couple things. Forbearance is still there. It's still available 90 days. But they're going to cash flow sweep everything. You're going to have to pay it all back within 12 months. And you're going to have to work with these tenants. You can't be charging late charges to them. And so that's on the forbearance side. And, you're not going to be able to evict any tenants. And so, that's until I think end of July for the CARES Act. And then on the new loans, we've talked about these reserves significantly. But I would say, on the Fannie side, it's essentially 12 months, P&I, taxes, insurance, and replacement reserves. That gets released after 12 months is the minimum. So 6 months and then 2 consecutive quarters at the debt service coverage that is required. So if you do a higher leverage loan, it's 125. If you do a lower leverage, it might be 135. If your loan is under $6 million, it's 18 months P&I, 12 months everything else. And then the assumptions, if you do a straight loan assumption, it's not going to require any additional reserves. But if you do the assumption plus supplemental, it will require the reserves. And then on the Freddie Mac SBL side, it's essentially 12 months debt service P&I. And they're going to require tax and insurance escrows, but that's typically going to just be about 3 months on taxes. Insurance, you'll probably just pay the first full year at close anyways. And then their release provisions a little differently, right? So they're saying we're going to release after federal, state, and local declarations are gone, at least for 90 days. And then your occupancy for at least 3 months is 80% and your collections are met. So essentially you're collecting at what they underwrote. And this is the part that has been a little bit harder for people is they used to be able to give exceptions, right? So let's say you weren't local to that market, you could get an exception for that. Or if you were first time, you could get an exception for that. But that is, a lot of those have been pulled back. And so, if you're going into a deal, they're going to be pushing a lot more on local sponsors and experienced sponsors. Let's see. And then in terms of collections, they're really looking at your current collections. So if you submit a deal in the beginning of the month, they're going to look at the previous. But if you submit a deal 16th to the end of the month, they're going to be looking at that current month's collections. And if there's a bigger than 10% drop, then they're going to underwrite to that T1, which can hurt your net rental significantly. So, with all of that, people are like, well, how are you going to get any deals done here? And so I wanted to talk about a couple of deals that I've seen get under contract through all of this. So on the left-hand side, I want to start with this deal. So it's a Class B deal, just got under contract. It's stabilized, 90% occupied. They originally went out about 29, 30 million in that range, came in probably 7% lower than that. And they thought that was a good enough discount. It's a high quality deal. Going in, cap is still 5%, right? So they're going in 5% cap. They think there's 150 per unit upside in rents just based on where the market is today, not above the rental. They're doing agency, and they need to raise about $10 million, but about 8 million of that is from a 1031 exchange. And so I think that is what is driving this deal more than anything else, is that person is significantly motivated to do the 1031 exchange, and they are going to have a 10-year hold. And so what that means is they're doing sort of a light rehab right now, bring the units to the current rents, the current market rents, but they're not going to do a huge upgrade program. And their plan is to maybe pull out, let's say you do a supplemental of $2 to $3 million in year 3, do the supplemental, and then do a majority of the rehab at that point in terms of interiors, and then hold it for longer term. So that's one example. Second example is the Class B deal, sort of North Dallas, stabilized deal. They're getting about a 10% discount to pre-COVID. It was a straight loan assumption. And so it's a stabilized deal. So it's probably 65% on the loan assumption. No supplemental, no interest reserves. And the seller had owned the deal. I mean, he's essentially, he's going to probably make $6 to $7 million on the deal. And, he probably would have made 8 or 9 million if he sold it a year ago. Right. But, he's happy with that return. He's going to move on and redeploy that capital. So the seller, even though he launched the deal in February and, it got really choppy in March, someone decided, hey, we've got the loan assumption. We know the interest rate. We know the loan amount. We just got to go out and raise the equity, and felt comfortable with that location. So let's talk about rates. On the Fannie side, they have floors on their index. So 10-year is 0.9 right now, but, even though 10-year treasury is 0.6, on a 10-year, we're seeing about 320 or so. So low threes on 10 and 12-year money. And then on the Freddie SBL side, we're seeing sort of mid threes to low fours, depending on the market and depending if you're doing yield maintenance or a step down prepay. And then, in terms of life companies, CMBS, they pretty much not quoting retail or hospitality for obvious reasons. And then apartments and industrial, they're still quoting out there. And so that was the overview today. If you guys, I'll send out the slides. My background is really underwriting deals for the last 10 years at G Capital. And then, the last 5 years, we've been, focused more on originating multifamily loans across the nation. And then I've also invested in close to 7,000 units in Texas. And so definitely put in your questions in the chat, and I will start going through those and sort of formulating answers while you guys are putting in the chat. And then definitely, so if you haven't been to the YouTube channel that I put on, subscribe to that, and then join the email list there. And then if you have more questions about, buying, selling, refinancing your next multifamily deal, definitely reach out to me. So let's go into Q&A. So we had like 200 people register for this, and I got probably 50 or 60 questions. So I'm going to try to get through as many of these as possible. But let's start here at the top, and definitely put yours in the chat, and then we'll get those. So Jade said, recourse versus non-recourse. Is recourse even possible right now? Banks have pulled back a lot, and, they have, like the Wells Fargos and Bank of Americas of the world, they have retail exposure, they have hotel exposure, they have all these different exposures. And so they are pulling back a lot. So what I'm seeing them do is they want local, if you're going to do recourse, they want local borrower, and they want you to have experience in that particular asset type. And so if you're a multifamily guy and you want to do a 65% loan, that can get done as long as the property is local to that bank and to you, right? So if you're in Dallas and you want to buy a deal in Houston, that's going to be harder, right? So they want local people, and then also a track record of multifamily experience. Number two, Scott asks, how difficult are agency financing terms for a first-time deal sponsor? I would say it's very difficult right now because they've pulled away the exceptions. So before we could get, the mitigants to it would be, we're gonna have third-party property management, and we're gonna do lower leverage, right? And so I think those are still the mitigants, but I would much rather you partner with somebody who has multifamily experience, so that you guys as a team can put the deal together and get agency financing. Number three, how do you structure a deal with multiple investors? So I think it's really going back to that GP-LP structure and making sure that each person is getting a part of the deal that works the best, right? Based on what they're bringing to the table. So the more things that you're bringing to the table in terms of raising equity, finding the deal, net worth, liquidity, multifamily experience, the more things that you're bringing, the higher percentage equity you should get in that deal. And then limited partners, most of the structure right now has been just sort of like a straight 80-20 split. And I think most limited partners understand that. Jeff asks, is loan assumptions with futures supplementals the best strategy in 2020? In terms of loan assumptions, I think that provides a lot of clarity for you, right? Because the loan amount, the interest rate. It might not be a great interest rate, right? So most of the loans that you're assuming today are going to be, 4.5% to 5%. So it's not going to be a great interest rate. I definitely, it would be very difficult to do a supplemental right now. So I would hold off on the supplemental, but I would even challenge you. Most people, if you don't need the money for the supplemental, I would just keep the loan assumption on there, run the deal, and then 3 to 5 years from now, just sell the deal free and clear, right? Because if you put the assumption, you add the supplemental, and then the supplemental is typically going to be a higher interest rate. So it might be like a 5.5% or 6% interest rate. And then you sell the deal like a year after you get the supplemental, that's going to add to your prepayment penalty. So unless you really need the money and you think you're going to hold the deal for a long time, I would just, do the loan assumption, raise the equity up front. You're going to be in a safer deal, and then just sell the deal free and clear, 3 to 5 years from now. Mary asks, do you think prices will come down for multifamily properties in the next few months? So the people who have stabilized deals, we saw the collections numbers, they don't have to sell, right? So if they don't have a maturity, they're not selling, they're just going to sit. So the prices of deals that are distressed, though, those prices are definitely coming down. And so I think it's very dependent on just sort of the quality of the deal, the location of the deal, but then also the current operations, right? If someone's struggling, if they're in a Class C deal, struggling at 60, 70% occupied, then those prices are coming down very fast because they're running out of time. But for the properties that are stabilized, those are just flat, and we're not going to have an issue with those. They're not going to sell. Douglas Pond, how are deals still getting done? We talked about it in the previous slide. It's really loan assumptions, and then people are just putting up the reserves, right? So we're seeing people put up those reserves, but then also we've seen where sellers have put up a portion of the reserves, right? So the seller, instead of taking down his $5 million, he's saying, all right, look, maybe you can pay me a little bit more. So instead of me selling it to you, making $5 million, maybe I sell it to you for 5.5 million, and I'll just put the reserve up of 500,000 for you, right? And because that's your big gripe, is that there's reserves now. And so we've seen some sellers hold their proceeds in escrow until those reserves are done, and then they get the money back. So that's one interesting way that we're seeing deals get done. Jeffrey asked, when will reserves go back to normal? On the Fannie side, they sort of took the 6 months plus the 2 consecutive quarters of 125 debt service. And so that doesn't really give you that much guidance, except that we've got a year from now. But Freddie was a little bit different. They said, we want all these, stay-at-home restrictions and lockdown restrictions to go away for 90 days, and then 3 months after that. So I would say you're probably 6 months away from reserves going back to normal. So I think you have to see the lockdowns, all that stuff out, and then you need 3 months of good collections data, and then Freddie will start, removing or scaling back those reserves. So it might go from 12 months to 6 months to 3 months. Number 8, Jeremy asks, should I invest in multifamily during this pandemic? I think if you can find a deal at good pricing, right? So the last 2 weeks, we've interviewed some of the top investors. One was from Madeira, which owns, 10, 15,000 units. And then we interviewed David Moore with NightVest, and they're investing right now in multifamily. So they're seeing dislocation on deals, and they think, their basis is good. They have a huge track record of buying deals. And so they're still buying deals right now. I think you have to be lower leverage, and you have to be very confident in your equity raise. All right, number 9. Should we reach out to you even before we find a deal? Do you lend nationwide? So yes, we lend nationwide. And I think, yes, right now is the time to sort of reach out, get familiar, put together your PFS, figure out what type of deal you can do based off your balance sheet. And then who else on your team, who else on your sponsorship team should you be filling out, right? Who's the guy with multifamily experience? Who's the guy with net worth and liquidity? And then as deals come up, you can start addressing them, and then I can start giving you loan term sheets so you can start underwriting these deals. Blake asked, how has the financing process changed since COVID? In what ways can we better prepare for the next 12 months? The biggest thing is reserves and timing. So reserves, whether it's Fannie or Freddie, 12 to 18 months. In terms of, process, I would say everything's slower. So it's probably 60 to 75 days now on financing. And then in terms of being better prepared, I think it's really just sort of building that sponsorship team, but then also building your base of investors. So I think that's going to be the most important thing. Number 11, Cody said, what's next, deflation or hyperinflation? So I showed you that chart of inflation earlier, and, the last, 1930s, 1940s, all the way till today. And it's essentially been inflation for the last 80, 90 years. So I don't see the deflation coming. I see it small pockets, right? So you see it in oil, and you see it a little bit maybe in technology, but then I think there's going to definitely go back to that 2 or 3% inflation that we were seeing. The amount of money that's in the system right now, that's why I'm in real estate, right? So I don't know what that hyperinflation is going to look like. I don't know if rents can run another 40 to 50%, but when when they're printing so much money, you need some of your money in assets that are indexed to inflation. And so, especially if you're gonna have to pay to keep your money in the bank, I think people are gonna want to buy assets like real estate that are indexed to inflation. Naveen asks, how do you start sourcing passive investments? And I think that really starts with general partners, right? So how many general partners do you know? And that was, when in 2015, that's what I started really looking at multifamily and getting to know as many general partners as possible. And right now, the general partners have plenty of time. They're not hunting deals as much as they could. So really get out, start meeting general partners, ask them the hard questions, right? Ask them what they're looking for in deals, what's their return criteria. Figure out. I would also ask them, what maybe can you refer me some of your previous investors, and then talk to those investors, right? And start figuring out like what's the monthly communication rhythm, how did they improve the value on some of their properties. So I would start there, and then your job as a limited partner is essentially to meet general partners. So get out there and meet as many general partners as you can. Emmanuel asks, how do you know you're receiving good loan terms? Um, so if you work with a mortgage broker, that mortgage broker should be in the market pretty much every day, every week. And they should know what the standard is for that type of deal, right? If you do it alone, if you do go direct and try, let's say you walk into Bank of America and try to get a loan and they just throw out something to you, you don't know. And so, leave it sort of, that's why I say leave it up to the experts really in financing and what we do. The same way that you hire a property management company or you hire a buyer broker or insurance broker, like this is what we do. And so we can compare it to, because we're closing so many deals every month, we can compare it to what other people are getting and make sure you get the best loan terms. Doug asks, what's the best way to position yourself for distressed properties? You have to be seen as a closer. And because a lot of the deals right now on distressed properties are not going through the standard. All right, we're going to list the deal March 1st, and then we're going to have tours for 3 weeks, and then best and final. We're going to choose a winner in April. Right now, it's like, here's the rent roll, or here's a picture of the property. You need to buy it. The price is $5 million. You want to buy it or not? You're not getting a rent roll. You're not getting a T12. You're not getting any information about the property. You're going to have to do all that information yourself. So in terms of positioning yourself, I think the biggest thing is cash. And whether that cash comes from yourself or that cash comes from other limited partners, you have to be prepared to show the seller that, look, I can close. That seller might be the lender, right? And the lender's saying, all right, what's your experience, right? Because the current owner isn't doing a great job. What are you going to do differently, right? So showing your track record, but then also showing how much cash you have ready to go to reposition this deal. Number 15, Gijo asks, the past couple of years, it's really been sort of value add rent increases. You go in, put in $5,000 a door, bump the rent to $150 or $200, and that's how you drive value. And so what's going to change, right, in multifamily investing? And I would say right now that, the rents are not going up, right? So they're flat to negative right now. So the only way that you're going to really change the value of the property is on the revenue side is really occupancy. And so when you're looking at these broken deals and the occupancy is 60% or 70%, maybe economically, it might be full, but 70% of the people are paying, 30% are not. Going in and changing the value of the occupancy and keeping the rents the same is going to be the new value add. Is really going to be an occupancy play. And then on some of these deals, they might be self-managed. They might be not run efficiently. So on the expense side, you can go in and change a lot upfront, especially if, you're having an issue. Let's say you're having water leaks all over the place, or you're having issues with the boiler going out or the chiller, like coming in with fresh capital and fixing all those things so that you can get the expenses where they should be. Number 16, Jeffrey asks, how should I underwrite in this economic environment? Similar to Gijo, I would say, flat to negative rent growth for the first couple of years, and then really focused in on occupancy. And then, going in cap rate, going in yield is very important. It's gonna definitely be harder on broken deals to achieve that. So I think you're gonna have to pick the lane that you want to be in, right? So I think there's 2 lanes. One is I'm going out for broken deals. There's not going to be any cash flows years 1 through 3, and we're going to sell the deal in year 4. and all your return is going to come back at that point. Or the other type of deal is, look, I'm going to just buy it at a 5%, 5 to 10% discount. I'm going to, get low, long-term debt, low interest rate, and I'm just going to cash flow this thing. Right. And, it's not going to be great for the first couple of years, but I think coming out of it, it's going to be a lot better. And so I think depending on the lane that you're in, whether it's, heavy value add or just, sort of your light value add, and then hold process, then I think that it's two different underwrites. So here's a little bit more on the reserves for everybody. Let me check the chat and see if you guys had any additional questions here real quick. Let's see. All right. So one of the questions from Scott was around sort of strong mitigants for lending to first-time sponsors. I would say it probably starts with how you're going to manage the property. So let's say your first-time sponsor on that deal, Cambridge, which was here in DFW. The number one thing that they want is probably someone local. Number two is they want a third-party property manager, so somebody who manages a lot of properties in DFW. And then number three is they will probably turn down your leverage, right? So instead of giving you 75 or 80%, you might be at 60 or 65%. And then, number four, if you can have someone sign with you, that would be great. But if you can't, then I think the biggest thing probably is leverage in terms of strong mitigants to getting that done. And then, if I was talking with an attorney and he had run a law firm. And so maybe showing some of your previous business experience would help also on that regard. Let's see. Mike asks, what are you seeing for number of days to close, number of days for due diligence? Due diligence, I would probably peg at probably 21 to 30 days. And then number of days of closing. We used to always do 60. I think you're probably fine at 75 days for closing, and probably have 2 15-day extensions in there as well. Let's see. Okay. All right. I think that is it. I think I covered all the questions. I appreciate everyone jumping on the call today. Definitely, shoot me an email, give me a call if you have any questions about, buying or selling or refinancing your next multifamily deal. Thanks a lot, guys.